Okay, everybody. Good morning once again, October 14th, 2024. My name is John Mooney with Guaranteed Rate Affinity. My co-pilot is Mr. Aaron Wise. Good morning, Aaron.
Good morning. How we doing?
We are doing excellent. We had a nice London tea party with the Chicago Bears yesterday morning, so
Yeah.
feeling good. This town is a different place when the Bears are relevant and competitive, so something to feel good about. Just a quick reminder, our Mortgage Monday calls the second and fourth Monday of every month, a quick 20-minute live call where we give you a shot in the arm with lending updates to how to build and grow your business. Um, let's go ahead and get started. So over the last week, we've actually seen interest rates take just a tick up, which is what we've seen week over week, ironically, since the Fed cut rates back on the 24th of September. Okay. After a lengthy decline prior to that cut, which was precipitated by lower inflation and a cooling labor market, and hints of a Federal Reserve policy change, rates appear to have, potentially bottomed out here between now and the end of the year. Okay. Like we always talk about, the market does not wait for the Fed. The market gets ahead of the Fed. And as we've seen, about 6 weeks before that cut, rates were pretty consistently coming down. Rates have marginally gone up week over week since the 24th. Okay, so right now we're probably in the low to mid sixes on a 30-year conventional, maybe a 6.5-ish, 6 3/8. Whereas we were maybe an eighth or a quarter lower looking back prior to the 24th. Okay. Um, Anything you want to chime in as far as interest rate activity there, Aaron?
I'd love to, sir. I'd love to. So I think there's two sides of this coin that everybody needs to understand. One is really important, and as far as the semantics are concerned and the details, and essentially the other one is the psychology behind it all, right? And I think they're both probably equally as important. So what's essentially happened since the Fed made their move is rates have moved inversely, right? I mean, it depends on the scenario, but um, the Fed making their move is essentially a lagging indicator on what's going on within the market. Okay. So we've touched on this a little bit before, but the nuts and bolts of it is when inflation moves in the right direction and jobs and unemployment and all those things that are market movers happen, the Fed comes in and essentially stamps their validation on it, more or less, right? And so it kind of acts as sort of an endpoint to a time period. And then it's okay, what's going to happen between now and the next time that the Fed meets? And essentially what's happened since that last Fed meeting is we got a really rough jobs report. And when we say a rough jobs report, we really mean the inverse of good news within our economy. So it essentially said that we've added a ton more jobs than what was expected. And the bond market takes that as, oh, well, we're still moving pretty hot here, so we need to calm down. And all of a sudden, rates pop up a little bit, right? So that's really what's happened since then. Now, the opposite side of that coin, which I think is what's important here, is if if your customer thinks that rates are down and they think that now is a good time to buy, then that's their reality. That's what they're living in, right? So we don't want to, pee on the fire or whatever we want to say, but we do have to, it gives us an opportunity to give them realistic expectations with what's going on. So I feel like, a lot of times buyers right now will come to me and they'll say, "Hey, rates are low. We saw the Fed made the move," and you don't want to stifle their enthusiasm too much, but we do have to give them a little bit of dose of reality. The easy way to do that is to give them accurate quotes on what an actual mortgage would look like as far as their monthly payment is concerned. So to me, I think that's what we need to all be focused on right now is, okay, if the market thinks that now is a good time to buy and the public sentiment thinks, okay, rates are down, then let's go. Let's wrap our arms around that. Let's agree with it per se, and then deliver some accurate quotes based off of, what a monthly payment would actually be right now. So I just wanted to chime in on that because I think it's important to differentiate between what's really going on, what the market is really doing, and then what the public sentiment is. I think that's super important. So I think that's a long story to how we get there, but I just wanted to chime in on that.
Yeah, absolutely. So a question just came in from Betsy. Was the increase expected? And we actually talked about that on this call a few weeks prior to that cut. And, no crystal ball here, obviously, but we said this might be one of those cuts that actually spurs the stock market, that actually has rates increase marginally. So this is the stuff we talk about on these calls, right? So Aaron is exactly right that, what we're looking at here, we don't recommend people try to time the market when it comes to home prices, home values, as well as mortgage rates, because you'll spin yourself in circles for days. But what we're looking at here to anticipate future Fed activity and future interest rate activity is jobs numbers and inflation numbers. Okay. And, on the side, coming into the end of the year here, we're going to be looking at retail sales numbers. Okay. Because if people aren't spending money as they're expected to into the holidays, that can put some pressure on interest rates and have, the treasury market react, where consumer spending is a large portion of this stuff, as it's tied to inflation and job numbers, right? So that's the stuff that we're looking at going through the end of the year and into quarter 1 of next year. Okay. First week of October, mortgage applications overall actually dropped by about 5.1%. Okay. But at the same time, refinance applications actually increased by about 10%. Okay. This is actually a good sign. When you have refinance applications being a tiny little sliver of the pie, that's a signal that something is off somewhere. So as compared to year over year numbers, the interest in refinancing activity is up, which is a good sign. Okay. And then to Aaron's point, the inflation report CPI that came out, overall inflation was 2.4% on an annual basis, which was down from 2.5% previously. So when you have that, in addition to that jobs number that Aaron talked about, where there were more jobs added to the economy than anticipated, we've seen rates kind of tick up marginally as a result there. Okay. Now we will probably see revisions to that number over the next couple months. So maybe it wasn't 255,000, maybe it was 230, maybe it was 210. So that's stuff that we look at as well when future reports come out. Moving on here to our next topic. Before I get to the topic, I'm actually going to plug some people here. And I will send this out as part of the recap summary that we send after these calls. You can vote for the 2024 Agent's Choice Award with Chicago Agent Magazine. And we hope that you vote for Aaron Wise as Loan Officer of the Year.
Hey,
as well as Natasha Robinson, who works out of our Hyde Park office as Social Media Influencer of the Year. So you can vote daily per device between now and the end of the week. So please continue to do that. Thank you for those chiming into the chat here. Appreciate the love and appreciate the support. We'll throw a big party if Aaron ends out the week.
we will. I promise you that. I promise.
Moving on to a new program that is getting launched with us this week. This is very exciting, and I think this is prime for some marketing to all of our databases. There is a Cook County down payment assistance program where our buyers can get up to $25,000 towards down payment, closing cost assistance, buying down that interest rate. This is an exciting program to add to our arsenal of programs that we have for affordability right now. So a couple of quick points on it. One thing that's unique is this is not a first-time buyer program. Okay, you can own other real estate and still take advantage of this program. It is a forgivable second lien with a 5-year term with 0% interest on this money. Cook County has $3 million in funds available in this program. So there is a shelf life on it. It will not go on forever. Once the funds are gone, the county has to appropriate more funds, which may come right away. It may take a while. So call to action. If you have people that can benefit from this, let's get in front of them now and start having a conversation. The other thing that I really like about this program is that it is able to be resubordinated with a refinance. Okay, so if we compare this to the IDA program, which comes from the state of Illinois, they do not allow subordinations. So you can take that $6,000 from state of Illinois today. If rates drop a half point next year, your customer wants to refinance with IDA, they're going to have to pay off that lien out of pocket in order to refinance. Not the case with our Cook County program. So just wanted to call attention to that. There is income caps on it. It's 100% of the AMI, the area median income limit. There are discounted rates available if they happen to be under 80% of that AMI income limit. We do have conventional and FHA, VA programs available for this program. It can be on a single family, condo, townhome, or a 2-unit. So 3 and 4 units do not play in this program. Primary residence only. So, Aaron, anything that I didn't cover, anything you want to call attention to on the Cook County program?
No, it's getting a lot of pub already. So I had 3 inquiries come in over the weekend on this thing. I think what's important right now is just the fact that there are a million programs. This is a very easy time to steer a customer. That's the wrong word, probably. Maybe have the customer call us if they're in touch with, their Chase or another nightmare bank that you just don't want to deal with. The chances of us being able to put somebody in one of these buckets is extremely high right now. I went back and just did some quick math. Yeah, I'm sure, John, you had some of this too, but my grant offerings for last month were $19,500 that was given away. That's a big number. And that went to 6 different buyers. So, and these are all different. I did my first $2,500 grants. I've had a bunch of the 3,000 and then a bunch of the 8,000. So, we can get even, for the agents that are on our call, it's kind of funny. There's a person that handles a lot of these products and programs, and he was on a call with all of us saying, I don't even know how you guys keep track of all these things. There's so many different programs, so many different options. What if they are a first-time home buyer? What if they're not? What if they're living here? What if they're buying here? So it's John and my jobs to just know all this stuff and be able to plug somebody into one of those scenarios. So what I'm getting at here is it's important just to know, enough to be dangerous, as they say, and then be able to say, hey, why don't you give us a call, at least see if they can, fit you in one of these products or programs and let us take it from there. You don't need to memorize every single, attribute of each individual program. You just got to know enough to be dangerous and say, hey, listen, these guys have programs that can give you between 2,500, $3,000, $8,000, now 25,000. That's freaking bonkers. So, John, you've been doing this for a couple decades, I think, myself as well. You got 40 years of we've never seen this much money being thrown around. And on top of the grant money that comes along with all this stuff, it's lower interest rates and lower mortgage insurance that couples with the grant a lot of times. So not only are they getting assistance to do the deal, but they're getting much better affordability while they're doing it, which is huge. I mean, that's like I call it a three-pronged benefit right now: lower rate, lower mortgage insurance, and then benefit with a grant. It's as good as it's probably ever going to get. So this is the time to be advertising that. What I would do is I would go straight to my social, whatever your flavor is, whether that's a LinkedIn or an Instagram or a Facebook or whatever, um, and just put a plug out there that says, "Hey, listen, I've got a program at my disposal that'll offer anywhere between 2,500 and 25,000 bucks. Give me a ring if you want to chat about it." You'll get somebody that's going to give you a call, and somebody's going to come out of the woodwork. Um, that might make a move here in the next, I don't know, 6 months, 9 months. So
Yeah, and we'll have marketing materials that you can kind of co-brand or, piggyback off of as well. Aaron's exactly right. I mean, for the majority of time prior to the last year and change or so, the first time buyer programs are more of a marketing, flashy, shiny object than anything. It would be, oh, great, you're a first time buyer. We'll let you put 3% down instead of 5. Congratulations, right? Um, but now there are a ton of these programs out there. They are very real. And they're very nuanced as well, right? So again, don't feel like you have to be the subject matter expert on stuff like this. My recommendation is when you're doing a buyer consultation, and if you're presenting the commission agreement, that's the time to kind of say, hey, listen, like some of the benefit of my service is working with, me, Mr. Real Estate Agent, is I've got an entire team of folks, inspectors, lenders, attorneys, handymen, what have you. Um, so it would make sense to, if you're looking for different options out there, there are more first-time buyer programs now with real benefits than I've seen. I'm sure Aaron would agree in the last 20 plus years. Okay. So some of the things that we're, digging into here to differentiate which program's the best, what's eligible, what's not eligible. And these are the ways these programs differ. Okay. And because part of your talk track with your clients, if they say, no, I've got a lender, they've got a great program for me. Well, is there any grant money, down payment assistance that comes with that program? If there is there a lien on the property as a result? Is it forgiven or is it prorated? What property types does it pertain to? Are there income restrictions? Are there geographic restrictions? And ultimately, where does the money come from, right? The programs that are exclusive to us, the $8,000 first-time buyer program and the $3,000 first-time buyer program, no liens, no repayment. Okay. Those are the most flexible options that are out there. We know there's the IDA program that's been around for, probably a decade at this point. And for those people that qualify and that's their niche, that's a great option as well. But it does come with some strings attached. Now with the Cook County program, there's more flexibility there, but there are some income restrictions that come into play as well. So all of these things are kind of what can directionally take a buyer to one option or the other. And it's more important than ever, I think, that we empower our customers to take advantage of these programs, educate them as far as what's out there. And it's changing, almost on a week over week basis. Okay. So a lot of cool stuff there. Aaron, anything you want to cover here before we start wrapping up and getting people on with their day?
yeah, just a quick question from Mr. Garcia in the chat. He's asking, for those that can't see it, can any of these funds or programs be used for the buyer to have representation, aka agent fee? Which is a good question. I believe the answer is no. And that, though, carries with it not a bad answer here, because even though it can't go directly towards an agent cost, and John, tell me if I'm speaking incorrectly here, all of these, well, most of these grants, this money is going towards everything else. So, for instance, if I've got 8,000 bucks that's going towards a buyer, it's really just going all in. I just call it in one pot, right? So if I'm a buyer and my down payment and my closing costs and let's say I'm paying an agent out of pocket, that's all going in one big bucket. Um, the grant money that I'm going to get also goes in that bucket. So even though it's not directly said that it's paying an agent commission, it's paying something else to help pave the way for the buyer to have more money to then go ahead and pay the agent commission. Am I saying that correctly?
Yeah, so ultimately the pile of money the customer brings to the table goes for down payment, closing costs, and more commonly, like these days and going in the future, the real estate commission, right? So uh really those funds can go for just about anything the customer is bringing to the table. Okay. Um, Question from Jill here. What are the income level caps? Those differ depending on the program, but they're typically a percentage of the area median income. So right now, the area median income in Chicago, Cook County is 109,000. We have programs that's the limit, the 109,000. We have programs where you have to be under 80%, which is 87,000 and some change. And we have programs that are 140% of that figure, which is 153,000. Okay. Interestingly, these programs differ as to what is required to constitute as income. Okay. So some of these programs will look at pay stubs and tax returns and take every dollar that's on there. Other programs will allow us to be flexible. Most of our programs have this flexibility. So, for example, that 140% of area median income is 153,000. We've had clients that have 150K base, and then they make 100,000 in commissions or bonus on top of that. Okay. So long as we qualify with that 150K base, we can get people into this program, even if they're making 200, 250 a year total. So long as that salary, for example, is 150K or below, we'll get them eligible into this program. Okay. So just to repay, if that gets into the nuance and how these programs differ and why it's important your clients are talking to a professional, preferably someone that has an open carrier platform like we do at Guaranteed Rate. We've got probably a dozen or so of these programs. We have probably 24 or so different banks and credit unions that we work with. So it allows the customer to kind of shop the market, talking to one person, Aaron or myself, to empower them to get the most options and the most impact as far as making this financial decision.
Yeah.
So last question here from Jill. Are we getting a lot of contracts with buyers having to pay the buyer broker commission? I've seen it a couple times. I'm not seeing it, a lot. It seems like I'd say probably 97, 98% business as usual on this kind of stuff. So we're not seeing it, but never say never. We have seen it. And it's one of those things where when we do see it, we have to qualify the customer with their bank statements to show that they have the ability to make that down payment, closing cost, and buyer's agent commission as well. So our best practice is when we're having that initial consultation with the buyer, we're asking if they can send us that agreement so we can plan accordingly. Or if the contract comes in and we don't have that agreement, we're asking for it up front so we can set expectations appropriately with the customer. But Aaron, if you're seeing anything different, let me know. But I would say it's probably 98% business as usual here, what we've been used to.
Same thing. The only thing I would add is one little tidbit. All of those that are paying, it seems like they're combination deals. So what I mean by that is the seller is only paying 2, but the buyer agreement is 2.5 or 3. So my buyer is only paying that extra 1 or whatever it is. So I haven't seen any in a couple months where it's all buyer paid. It's a combo, which is really the same thing. I mean, in the end, we still need the buyer agreement. We still got to qualify them based off the number. I just thought that was interesting that it was a combination effort there. So, yeah.
Yeah, absolutely. And as we wrap it up here, just a reminder that we do not consider a seller credit to cover buyer's commission to be part of the interested party caps. Okay, so we've talked about it before, depending on the down payment, 3%, 6% credit can come from seller to buyer to cover things like closing costs. If the buyer's paying that buyer's agent commission out of pocket, we don't consider a seller credit to cover that part of those contribution limits. Okay, so if you have those situations, feel free to reach out to us, but we're going to let you know, hey, go ahead and make the offer, include a credit towards your commission if needed. We'll take care of the rest. So,
Yep.
Coming up on the top of the hour here, as a reminder to all, vote for Aaron Wise, Loan Officer of the Year for Chicago Agent Magazine. My name's John Mooney. We'll get the recap out to you guys shortly, and we will see you in 2 weeks. Next call coming up on the 28th of October. Have a great week, everybody. See you in a couple weeks.
Thanks, everybody.